Something just broke in the silver market. And almost nobody is noticing. JPMorgan, one of the largest players in the precious metals world, has quietly moved more silver than most retail investors could even imagine. We're not talking small numbers. We're talking hundreds of millions of ounces, enough to tilt the market if a fraction of it were ever called back. If you don't understand this move, you could be looking at the largest silver shock in years right under your nose. And the scary part? The mainstream media won't tell you a thing. Before we get too far, hit subscribe. This channel is your inside look at moves the markets don't want you seeing. Share this video with anyone who thinks they're safe, holding cash, while the banks quietly shift mountains of silver. JPMorgan has been hoarding physical silver at a pace that dwarfs their previous years. According to the latest COMEX warehouse reports, their registered silver stock rose by more than 20% in the past 6 weeks alone. That's over 50 million ounces added to a vault system already strained by industrial demand and retail frenzy. To put that into perspective, in 2020, during the peak of the retail silver squeeze, the largest weekly inflow never exceeded 15 million ounces. This is 3 times that volume, quietly accumulating while prices barely reacted. Meanwhile, the physical market in China tells a different story. Shanghai Silver Exchange premiums are at multi-year highs, hovering at $1.25 per ounce above global benchmarks. In contrast, COMEX futures are still trading near historical lows. That spread shouldn't exist under normal circumstances. When physical silver in China is screaming demand and U.S. futures remain muted, it signals a disconnect, a silent tug-of-war that only insiders like JPMorgan understand. The opportunity for arbitrage is massive, but the scale of these moves hints at something bigger than just profit. Look at ETFs for another clue. iShares Silver Trust holdings have remained steady while physical delivery requests spike. GLD and SLV inventories aren't keeping up with real-world demand. In the past, a 5% divergence would trigger panic and fast buying. Today, the divergence is closer to 12%, yet prices barely move. That's not normal. That's a warning sign that someone is front-running physical shortages while the public is still focused on paper contracts. And JPMorgan sits right at the center of this web. To understand why this matters, you need to know how the US and Chinese markets interact. COMEX silver is largely paper-based. Traders buy and sell contracts, often never touching physical silver. Shanghai Silver Exchange, however, is heavily physical. Deliveries are real, industrial demand is real, and premiums are determined by actual scarcity. When a massive US bank starts moving metal, they're effectively bridging 2 worlds. One wrong step, or a sudden bank-driven physical demand surge, and the paper market could be exposed, sending shockwaves globally. Historically, banks have used this kind of positioning before big moves. In 2011, JPMorgan was accused of cornering the silver market, controlling upwards of 70% of COMEX registered silver. Back then, retail investors got burned when prices plunged after a sudden short squeeze. Today, their tactics are subtler, but the underlying mechanics are the same: controlling physical supply, manipulating spreads, and profiting from mispricing between markets. And if history repeats, even partially, the consequences could be catastrophic for anyone not paying attention. Meanwhile, industrial demand isn't slowing down. Electronics, photovoltaics, and medical devices collectively consume over 500 million ounces per year globally. That's nearly twice the annual mine supply. Add retail demand into the mix, and the system is under pressure. Inventory reports from major U.S. warehouses indicate withdrawals are accelerating. Last week alone, over 12 million ounces left COMEX warehouses, the fastest pace since early 2022. The market is screaming for silver, but the paper market still trades like nothing is happening. Why? Because banks like JPMorgan are quietly stockpiling, keeping the squeeze hidden until it's too late for others. And here's where it gets even more alarming. The largest positions on COMEX aren't held by speculative funds. They're held by banks with the ability to call back, lease, or sell silver at their discretion. When you combine that with the rising Shanghai premium, a physical shortage in the US could emerge almost overnight. Imagine a domino effect. Retail investors panic, industrial consumers scramble, and suddenly the paper price is forced to converge with the physical price. That's when the real move begins. And JPMorgan already knows it. What JPMorgan just did isn't visible on a stock chart. It doesn't show up in ETFs. But if you know what to look for, the signals are screaming. Physical silver is leaving COMEX warehouses faster than it's being added, yet futures prices barely move. This isn't random. It's a deliberate positioning strategy. Banks like JPMorgan are essentially setting up a hidden bank run on silver. They have the ability to call back metal, creating a vacuum in the physical market while the paper market remains calm. And when that vacuum is forced, prices will spike in ways retail investors won't anticipate. Arbitrage is the key mechanism here. Normally, when Shanghai premiums rise, traders buy silver cheaply in the US, ship it to China, and profit from the spread. But here's the twist. JPMorgan already owns vast physical stockpiles. By quietly hoarding, they're capturing both the premium and controlling the flow of metal. In practical terms, they are setting themselves up to profit whether COMEX prices rise or fall. This is not a small-scale hedge. This is a multi-billion-dollar positioning strategy designed to exploit a structural imbalance in the global silver market. Consider the numbers. U.S. COMEX warehouses currently hold roughly 900 million ounces of silver, while global industrial demand requires over 500 million ounces annually. Yet, more than 50% of that COMEX stock is tied up in large bank positions. In other words, half of the available U.S. supply is effectively off-limits to the market, unless these banks decide to release it. That's why paper prices remain muted. Despite rising demand, the market is being held artificially in check. And when those holdings move even a fraction, the market could experience an unprecedented spike in volatility. History gives us a roadmap. In 2011, silver prices spiked from $30 to $50 an ounce in a matter of months, fueled by supply constraints and massive short squeezes. This time, the scale is different. The Shanghai premium alone indicates that the physical market is already under pressure before any U.S. bank action. Combine that with over 50 million ounces of recent JPMorgan accumulation, and you have the potential for a move that dwarfs anything seen in the past decade. Analysts monitoring spreads, warehouse inflows, and ETF discrepancies are already signaling alarm, but the average retail investor is still oblivious. Analyst POV is critical here. Most professional observers focus on paper market price action and ignore the physical disconnect. But anyone tracking registered warehouse withdrawals, SLV holdings, and global shipping trends sees the story clearly. There's a tightening in the physical market, and JPMorgan is in a position to control the narrative. This is not about speculation. It's about controlling the flow of real metal. The stakes are enormous. Industrial users could suddenly find themselves scrambling for supply, and retail investors could be left chasing a price that's already running ahead. Let's look at another angle. Leasing rates. Silver leasing costs, which measure how expensive it is to borrow metal, have surged recently. At current levels, they suggest that those needing physical silver are paying premiums approaching 5% monthly. That's astronomical in historical terms. For comparison, during most of the 2010s, leasing rates rarely exceeded 1%. High leasing costs indicate stress in the physical market, signaling that the disconnect between paper and real silver is widening. Banks like JPMorgan are positioned to profit from this stress while others pay the price. Meanwhile, retail demand is quietly accelerating. Online brokerages report record silver buying from U.S. investors, particularly in coin and bullion form. Physical retail demand is less visible than ETFs, but it adds pressure to a system already stretched. Historically, when retail and industrial demand converge during a supply squeeze, volatility spikes. And if JPMorgan begins calling back silver, even a partial recall could trigger cascading effects. Prices could explode before mainstream media even recognizes the event. And there's one more element few are watching: cross-border flows. Silver shipments to Asia have surged in recent weeks, particularly to China, where industrial demand and retail premiums are highest. U.S. warehouse withdrawals indicate that metal is moving overseas faster than it's being replenished. That means any U.S.-based investor or industrial consumer trying to acquire silver may face sudden shortages. The market is slowly being cornered, and JPMorgan's moves are quietly dictating the pace. By now, it should be clear. This isn't normal market behavior. The combination of rising physical premiums, massive bank accumulation, supply stress, and arbitrage positioning is setting the stage for a potential bank run scenario in silver. Anyone ignoring this could find themselves on the wrong side of a massive move. And while paper markets remain calm, the physical market is already signaling an urgent alarm. Now imagine the consequences if this imbalance continues. Physical silver shortages in the U.S. could hit industrial users first. Electronics manufacturers, solar panel producers, and medical device companies rely on a steady supply. Even a small disruption could force them to compete in a market where paper silver barely reflects real-world scarcity. That's when retail investors will notice prices moving violently. But by then, it might already be too late to enter at a reasonable level. The market could spike, not in days, but in hours, driven by supply constraints and panic buying. And JPMorgan? They'll be perfectly positioned to profit from every ounce called back or leased. Retail investors are the most vulnerable in this scenario. Many are focused on paper ETFs or futures contracts, which can lag real-world price action. Physical silver buyers, on the other hand, are starting to feel the pinch. Premiums on coins and bars are rising sharply, with some dealers quoting 10-15% above spot. Historically, such premiums precede large market moves because they indicate a real shortage that paper prices have not yet internalized. When physical demand finally forces a reaction in the futures market, anyone who waits will be chasing a price that's already left them behind. Institutional investors are watching closely. Hedge funds that monitor COMEX inventory flows, leasing rates, and Shanghai premiums are starting to adjust positions quietly. The alerts are clear. The largest bank in the U.S. silver market is accumulating at unprecedented speed. This is a signal that a major market event could be imminent. For analysts, the question isn't whether silver will move, it's when and how severe the move will be. Those who act early have the advantage. Those who wait are exposed to sudden spikes in price and volatility. Consider what happens if a partial recall occurs. Even if JPMorgan calls back only 10% of its silver, that's roughly 5 million ounces pulled from COMEX. Historical precedent shows that such withdrawals can trigger cascading effects. Leveraged positions are liquidated, shorts are squeezed, and prices can gap higher before anyone can react. Combine that with existing retail and industrial demand, and you have the ingredients for a near-perfect storm. A bank-run scenario in silver isn't hypothetical. It's quietly unfolding in real time. Let's revisit the Shanghai premium. When premiums rise above $1 per ounce, it's not just an indicator, it's a warning. Physical metal is scarce and arbitrage is constrained. Shipping delays, rising costs, and regulatory barriers make it harder to move metal from the U.S. to China, meaning banks holding stockpiles have leverage. They can choose when, how, and at what price they release metal. That control is effectively a hidden throttle on the market. And JPMorgan has that throttle fully in its hands. This is why you need to pay attention now. The signals are everywhere if you know where to look. Withdrawals from COMEX, rising leasing rates, Shanghai premiums, ETF discrepancies, and industrial demand spikes. Each data point alone is noteworthy. Together, they form a pattern that screams imminent market stress. For anyone invested in silver, either physically or on paper, ignoring these indicators could be costly. And the mainstream narrative? Silent. Nobody is connecting the dots. Here's the bottom line. We are witnessing a structural setup that could trigger the largest silver move in years. Banks like JPMorgan are quietly accumulating, the physical market is tightening, and premiums are diverging dramatically from futures prices. Historical patterns suggest that when these forces converge, volatility explodes, and retail investors often get left behind. The moment to pay attention is now. Every ounce of silver withdrawn, every premium spike, every delayed shipment brings the potential for a sudden, explosive price reaction. If you're following along, this is your call to watch closely. Track warehouse reports, leasing rates, and Shanghai premiums. Notice how COMEX withdrawals accelerate. Watch retail buying trends. The moment the paper market reacts to physical stress, the move could be massive. And when it does, the headlines will scream. But by then, you'll already be positioned if you've been paying attention. Comment below if you're tracking silver yourself. Are you noticing these hidden signals? Share this video with anyone who thinks silver is boring or stable. They need to see what's unfolding. Hit subscribe if you want updates as this story develops, because the market isn't waiting, and neither should you. One final thought, the system is designed to hide these moves until it's too late for most. But now, you've seen the signals, understood the mechanisms, and glimpsed what could happen next. The bank run in silver isn't coming, it's already starting. And JPMorgan, quietly in the shadows, knows exactly how this will play out. Every day you wait without paying attention, the risk increases.